Welcome everyone to this week's CDAR seminar, which is hybrid. I'm Lisa Goldberg, CDAR's co-director, and I am super delighted to introduce my friend, David Buckle, who lists himself as unaffiliated these days, but I think not unbusy. If you were lucky enough to be on campus yesterday, you heard David talk about how the Babylonians may have computed the square root of 2. And if you're interested in that topic, in addition to this one, I'll be happy to send you his paper. It's quite fascinating. And here we are lined up for another talk that I trust will be equally fascinating: uncooperative parasites. Solving the prisoner's dilemma in the active-passive house of correction. Please go.
Thank you. Thank you very much. Am I visible for those on Zoom, or can you hear me?
We get a thumbs up.
We can hear you.
Yes, we can hear you just fine.
Thank you. The title of this presentation was put together for me for a friend of mine, Lisa, who asked me to present this. It's slightly misleading, so I want to jump straight into the agenda of what we're going to talk about today. And this is a piece of work that's been on my mind for a number of years, and it's to do with the active-passive debate. And the way we're going to think about it in this talk is to not take the perspective of an active manager. I'm not an active manager. I'm not trying to pound the table for active management. Neither am I a passive manager. My position is going to be what's the experience of the end investor in this debate. Now, we're going to walk through the following agenda. I'm first going to set the scene, so if you like, set a framework. I'm going to give us a refresher on the typical model that's used for making the active-passive decision. Very briefly, we're going to touch on what kind of numbers are used for things like Sharpe ratios and information ratios. The key part of the presentation is revising this conventional model for the situation where us investors are impacting the market we're investing in. Once that's done, it'll turn out to be a game theoretic situation. So we're going to consider two scenarios: what if investors collaborate, and then what if they don't? And the most controversial part of this paper, the most controversial part of the paper is this fourth thing possible. The reason why I'm very keen to present the very reason I'm very keen to come to Berkeley to give this presentation is I'm interested in people's feedback on this last controversial piece. As Lisa will no doubt discuss in the Q&A at the end, this is the bit where people seem to get most uncomfortable. The rest is reasonably uncontroversial. Let's jump straight in. We're going to build a nested model where investors do not invest directly into securities. They instead allocate their wealth to an agent, which we're going to call an asset manager, and that agent is the person investing in the securities. And now there's no loss of generality here. There's nothing to stop an individual investor appointing him or herself as the agent. The key feature of this structure is the investor is taking a single period decision to allocate to the asset manager, but the asset manager may be trading frequently within the same period. So that's the key difference. And we're going to break asset managers into two types. Firstly, passive managers, who we're going to define as managers who are not informed. They simply buy and hold the market portfolio. Those of you who are familiar with Grossman and Stiglitz's work, this is the uninformed investor. Active managers is everybody else who's not passive. So, of course, that is the conventional industry active managers at Fidelity or T. Rowe Price or something, but it's everybody else. It's me if I manage my own money and I don't follow an index. It's a bank managing its own capital. It's a corporation doing share buybacks and rights issues. It's everybody who's not passive is an active manager. Now, because active managers are the only traders inside the investment window, it is solely they that are responsible for price discovery. They are clearing the market. And this is going to be a very critical part of the presentation, this notion that active managers are here in the market and therefore responsible for price discovery, solely responsible for price discovery. They form a portfolio between them, and the passive managers buy this portfolio, which they view as the market portfolio. And as a consequence, we can consider this dichotomy of agents into two types. The active managers are responsible for forming the market portfolio, and the passive managers use the market portfolio.
I didn't ask, is it okay to interrupt?
Of course, yeah, you're very welcome to.
Okay, I'll interrupt right now then. So there's an issue, of course, well known to everyone in this discussion, that we don't really observe the market portfolio, and we have quite a few different conceptions of it.
Yes.
And I'm wondering if that is a distinction that is small compared to what you're going to be talking about, or just something we put aside anyway.
Yeah, it's not so much put aside as, although it's unobserved, the passive managers view the market cap portfolio as the market. Now, it may be that some passive managers operate, I don't know, some kind of excluded list of the market or some sectors of the market or something. But this sort of stylized model says that the passive managers are using the portfolio that was built by the collective efforts of the active portfolio managers.
Well, yes, but there are many, like the Russell 3000 and the MSCI.
Yeah, yeah,
And the Lehman Act.
yeah,
I mean, I can go on and on. So I'm just,
yeah.
I mean, to me, this is a big issue, but I don't know, maybe it's dwarfed by what you're talking about.
Yeah, now I should say that this is the whole of the capital market. So if you like, it's the cap weighted Lehman Ag plus S&P, if you want to put it that way. But this model is silent on the difference between using the Russell 3000 and the S&P 100. It simply has this notion of a cap weighted market of all securities. Okay, now the principle here is, because the passive managers are using the market portfolio without contributing to it, the phrase used in the literature is free levers or free riders, you sometimes see it written as. And again, I'm going to put a couple of what might be considered emotive phrases in here. This isn't intended to be an emotive phrase. It's simply the statement that this group of people are using something without necessarily paying for it. They're using for price discovery without paying for or contributing to price discovery. So I want to just walk through what I mean by price discovery with a little thought experiment. And the one which came to mind for me, people in my age group, is when Windows was introduced. It was clear right there and then it was just a major game changer. We were operating on these kind of terminals beforehand. You had to be skilled in programming to do even the most basic things, and Microsoft launched that. And it just changed everything. It was so obvious right there and then that it was a major, major game changer to personal computing. And what I want to do is walk through a thought experiment of there only being two active managers in our universe. What happens? Here's the price of Microsoft shares in the blue line, about 10 cents. Then Windows was launched. And let's supposing both managers believe it's going to have a significant positive impact on Microsoft share price. The difference being, manager A thinks it's going to be a 450% increase to share price, huge. Manager B thinks it's still going to be large, but 250%. What happens? Well, neither of them can buy because there's no seller. They both want to buy when the price is here. The only time the market can clear is if the price moves somewhere in here, in which case A still views it as cheap, but B views it as overdone, and B will sell to A. That sort of thing. Now, in this environment, A has been the loser. It wasn't overdone. It kept going. Red has been the loser. Green has been the winner. But the really important point here is they've both collectively contributed to price discovery. Both of them made the price of Microsoft share move from 10 cents up to 35, 40 cents. And in fact, that's pretty much what happened. It took a calendar quarter to reach there, but that's virtually the path that was taken. Okay, so that's price discovery, and that's going to come back to be fitted back into the model later in the presentation. But I want to stop now and talk about the existing model that we all use, the Treynor and Black model. This is my thumbnails of the people who should have won Nobel Prizes and never did, in my opinion. And Fisher Black we all know about, but Treynor Black's work is just superb for those who follow this kind of literature. It's a real shame he didn't win a Nobel Prize. But they wrote a model in 1973, how to use security analysis to improve portfolio selection. And funnily enough, it's not used particularly widely for portfolio selection, but it is virtually the sole model that's used to select active asset managers, either active or passive. And I'm going to walk through the model because this is going to be our start point, and it's also going to offer us some notation. So we start with a risk-free rate, RF. We have some kind of market return. So at least to your point, it's just literally RM. We don't know what's behind it. We just have a return for it. And then we build a portfolio of active managers, and the return on that portfolio is RA. And we can decompose it to be a risk-free component, a sensitivity to the market component, plus a residual. And this, of course, you can set theta, so there's no loss of generality here. It's a standard decomposition of a return. And we can then choose as investors between the market portfolio and the active portfolio, and we end up with a return as investors written on the bottom line here, an exposure to the risk-free rate, an exposure to the markets multiplied by the return of the market, plus an exposure to the active piece. That's the residual return of the active portfolio. W and Y we're going to focus on, so let's just make sure we've got them in our minds about what they are. W is the exposure to the market.
Can I interrupt with a question here?
Please.
Sorry. Why is it that we say theta is uncorrelated with the market?
Yep. Yes, beta is set to make that the case. So,
But in general, an active portfolio could be positive. The active portfolio could be correlated with the market.
Okay, right. So let's be clear on this. This is a terminology thing, so it's worth just drilling down on this. The theta here is the component of the active portfolio which is not correlated with the market.
Oh, that is not correlated with the market. Okay.
Yeah. So the variable you're talking about is RA, which is the total exposure.
Oh. Okay, got it. Got it. Thank you.
Right. Okay, and that feeds through to the W and the Y. So W is the exposure to the market. W will be consisting of exposure directly to the market, but it will also consist of any exposure to the market embedded in the active portfolio. So it comes from two parts. And this is all Treynor and Black's work, not mine. And I really like it. So W is the exposure to the market, and Y is the exposure to the active portfolio, and the residual return is Y times the residual element of the active portfolio. So W and Y are going to be critical for the rest of the presentation. Now, further notation here. I'm going to call the risk premium of the market mu. I'm going to call the risk of the market sigma, and the Sharpe ratio is just the ratio of those two numbers. Of course, we all call the expected residual return alpha, and I'm calling the risk of the residual return mu. Some people call this tracking error. I'm not so keen on that term. It's the risk of the residual piece, and information ratio is alpha over nu. And Treynor and Black suggested that was a representation of the skill, in their case of securities, in our case of managers. And the idea being that you maximize the investor's Sharpe ratio, SRP, which is just the risk premium of the portfolio divided by its risk. And the Treynor and Black paper says that is done by optimizing this function F, which is exposure. I'm just going to the second line in this equation. W, the exposure to the market, times the return to the market, expected return to the market, plus the exposure to active times alpha of the active piece, minus a penalized term for risk. And the magnitude of the penalty for risk is governed by lambda, which is the coefficient of risk aversion. And the beauty of this structure is that if you were to optimize this objective function f, you'd be left with optimal w just being Sharpe ratio divided by lambda sigma, and optimal y being information ratio divided by lambda nu. And the great thing about this then is you can separate the two decisions. Separate the decision for how much market exposure you should have and the decision on how much active exposure you should have. And in fact, Treynor and Black showed that the Sharpe ratio, the optimal Sharpe ratio of the investor is going to be square of the market Sharpe ratio plus square of the information ratio, which basically says invest in a market with a nice juicy Sharpe ratio and invest in skilled active managers. What numbers should we plug in to these? Now, I should say this is a theoretical talk, but we do need to have a sense of the order of these numbers. And here are 6 asset managers who thankfully publish their estimates of mu and sigma. There's nothing special about these 6 in the context of anyone else I could have picked, and they were the first ones that came out on Google. But just averaging and rounding, I'm going to take in this presentation mu is 5%. This is the critical number, sigma is 16 and a bit, which makes the Sharpe ratio 0.3.
What are the approximate dates of those capital assumptions?
They were taken in June of last year. Now, funnily enough, S, R, and mu aren't as important to this framework. This is an important number. It doesn't matter if you think it's, let's say, 15 or perhaps 20%, but it's in that range. And in particular, we're going to look at this relative to the size of nu, the residual risk of the active managers. We take lambda equals 3. This is straight from traditional literature, and it's a common sense check. It means the optimal market exposure for a representative investor is 60% invested, which is about right. The problem for us is alpha and nu. Now, here, active risk, again, in the empirical literature, tends to be around about 5%, maybe 4, it may be 6, but that's the sort of ballpark. And critically, it's a lot less than sigma, a lot less than sigma. And that has a couple of impacts. The first is here, that we look at the denominator lambda times nu. Lambda's 3, nu's 5%. So lambda nu is only 15% in the denominator, which makes the optimal exposure to active incredibly sensitive to the value used for IR. And I've just put a little calibration on here. If you thought that the IR was 0 or worse, you wouldn't have any active management at all. But you'd only need to think IR is greater than 0.15 before you're 100% active. And I put this calibrated scale on because if you speak or read the literature from active managers, they often claim numbers of around about 1 as the metric of a skilled manager. And if you plug 1 into here, you get a 666% active, which is also quite ironic. So what is alpha? What is alpha? Well, we're going to cover 3 cases. The first one is alpha equals 0. This is, if you like, the very conventional academic argument that, well, if the active managers represent everybody who is trading at any point in time, the aggregate alpha amongst those individuals must mathematically be 0. So the case might be, well, yes, on average it's 0, but possibly there are good managers and bad managers, and therefore it's possible for a single manager to have a positive alpha. But that would require that someone else has a negative alpha persistently. And the problem with that is that they wouldn't exist as an entity because it'd be better to be passive than to be allocating to them. And if there are none with negative alpha, there can't therefore be any with positive alpha. So alpha equals 0 is, if you like, the standard academic textbook claim. Could it be greater than 0? Yeah, possible. Remember we said that some agents might allocate their wealth. So, for example, I might allocate to myself as my agent, and therefore I might be a perennial loser, and the commercial asset managers might be winning from me. I might be the fool in the market, And I might carry on being the fool in the market, one, because I haven't measured it correctly, or I just enjoy doing it or something. So it's possible that alpha is greater than naught for some managers. The problem with such a claim is it's just very inconsistent with the trend of investors over the last 20 or 30 years. I've scraped this from a Federal Reserve report. We're interested in the black line. This is the proportion of the market that is passive. And in 1995, when I was not long in the industry, the proportion of passive was less than 5% of all investment. But you can see there's been a steady and potentially increasing trend. So now the exposure to passive is above 40%. This is for all funds. If I just had equity funds, it's already above 50%. So there's quite a substantial trend, and this will be indicative of the market not believing that alpha is positive. And when I say the market of investors. But the strongest claim is that actually alpha is less than zero. And this comes from Grossman-Stiglitz, which started off with the case of, well, alpha should be zero because everyone's competing against each other. But then there's a cost to being informed. If you want to be an informed investor, in the actual sense of being a practical investor, you're paying analysts or you're buying data to analyze companies. There's a cost to being informed. And once you've incorporated that cost of being informed, you've got the zero alpha gross of costs. It must be negative net of costs. And it led to something called the Grossman-Stiglitz paradox, which is to say, if after you've paid to become informed, you have a negative alpha, there is no point in becoming informed. Therefore, everyone would be uninformed. And if everyone was uninformed, there would be no market. But there is a market. So something's going on. And the actual title of their paper was The Impossibility of Efficient Markets. They conjectured, loosely actually, they conjectured that possibly the market isn't, the efficient market hypothesis doesn't exactly hold, which may cause alpha not to be zero after all. But alpha less than zero is the most compelling case, and all the empirical literature we've seen over the last 5, 10, 15 years all demonstrates that the alpha of active mutual funds tends to be less than naught, and typically tends to be equal to the negative of its expense ratio, the cost of the fund, which is what Grossman-Stiglitz hypothesized would happen. So one of the perhaps main academic contributions of this piece of work is that this model would explain that paradox, and I'll show you that in a few slides. But where the model differs from Treynor and Black is I asked the question, what if the active managers have some kind of impact on the market itself? And there's a very provocative paper written in 2016 by Inigo Fraser-Jenkins, and he titled it "Passive Investing is Worse Than Marxism." So you can imagine it created a lot of media attention. And the rough argument he made was as follows. He said, if you've got a capitalist society with a lot of active managers, there are many analysts allocating capital around an economy. And then he said, in a Marxist society, it's different. There's only one person deciding how to allocate money around an economy, which he argued was worse. And then he said, in a capitalist society, when there's only passive managers, nobody's deciding how to allocate capital across an economy. Now, I'm sympathetic with this notion. I don't know much about Marxism, but I'm sympathetic with the notion of no analyst being worse than many analysts. So I'm going to pose the question, what if the market performance itself deteriorates if there's less analysts? And the way to think about that is if there were none, we're going to do a thought experiment. If supposing there were no active managers at all, it effectively acts like absolute zero. The market constituents are stuck at that point in time. They couldn't possibly move from there because there's no one trading one security differently from another. And just to put this in perspective, my conjecture is this portfolio, so we're going back to the 1985 Microsoft example. These are the top 10 holdings of the S&P. IBM does our computing, very oil, chemical heavy. Our cars are GM. AT&T, do all our telephony. You compare that with 2022, Apple, Microsoft, Google, Amazon's where we do our shopping rather than Sears, Facebook, Tesla for automobiles. My conjecture is that from here going forward, the Sharpe ratio of this portfolio is likely to be higher than this one. So how does this actually fit into the mathematics? We're going to introduce a new variable P. And P, plotted on the horizontal scale of this chart, represents the proportion of investment that is done through active managers. And I'm suggesting that the Sharpe ratio is not an exogenous constant. I'm suggesting it is a function of P. I've put this wavy line in. I've no idea what the function is, but I'm just suggesting it's a function. And in particular, it has the property that the end when P equals 0 is lower than when P is 100. So the market Sharpe ratio, we're not talking about alpha here or the information ratio or anything like that. We're saying that the market Sharpe ratio is higher when you have more analysts assessing companies. And I'm just going to impose one condition, which I've called the analytic oath. The idea being it's the sort of equivalent of the medical Hippocratic oath, which is first that the analysts do no harm. And what I mean by that is that the gradient of this Sharpe ratio line doesn't ever go down. So if you get more analysts, it doesn't make the Sharpe ratio get worse. Could stay the same, but it won't get worse. And I'm suggesting that it could increase. So in that case, we can't say that passive managers are freeloaders anymore. And the reason we can't say that is because in the case where the Sharpe ratio is being negatively impacted by the increase of passive managers, now they've become parasites, is the word I use. And I'm just going to explain what I mean by that. It's a very good analogy in this context, in fact, because the virus itself, in this sense, is the passive investing, but the carriers are the passive managers. So they're the ones that give the opportunity to be a passive investor, and the host are the active managers. They're the ones being impacted by this. And I thought this was a great picture because who knows if it's parasitical or not? It looks like it is, but it certainly irritates the active management community, even if it is not. But that's the structure we're going to look at. And we're going to work out now, what do we do about that? What happens if that is true? The Sharpe ratio is not exogenous, it's endogenous as a function of the proportion of the market that is active. And of course, P is a function of all investors. So we need to think about how all investors behave relative to each other. So it becomes a game theory problem. And I'm going to therefore consider two scenarios. The first scenario is investors collaborate with each other. I'm going to explain what I mean by that in a minute. And the second scenario, what if they do not collaborate? So let's consider collaborating investors first of all. I'm going to make some simplifying assumptions here. The first one is that investors are able to form active portfolios which have the same alpha and nu. This isn't as strict as the homogeneity of expectations that you see in things like the CAPM. I'm not saying every investor has the same alpha and nu for every asset manager. They may have their own personal differing alphas and nus. What I'm saying is they're able to construct portfolios, and those portfolios have the same alpha and nu across investors. And this is an assumption I must make, but it's not a great one, that investors know what this functional form of the Sharpe ratio is. But in that case, there's a very nice outcome, which is Y star over W star, the optimal exposure to active divided by the optimal exposure to the market is going to be the same for every single investor. And if it is the same for every single investor, it must equal P. So in that case, an investor who's acting collaboratively can operate as if they are the only investor in the market. And just to be clear, what I mean by collaborative is by collaborative, I'm saying that investors work in the same way, i.e. they don't rely on someone else investing in a different way to them for some kind of benefit to them. If you like, they all do their bit to ensure that the market Sharpe ratio is optimized. And the way they would do that is they would optimize their function, their objective function F. Now, you might recall that top line looks very similar to the Treynor and Black model. The only difference is mu is now a function of P, it's not a constant. And what that does, if you optimize that function F and work out what optimal W is and optimal Y is, they're similar to Treynor and Black, but with an additional term. And we'll just walk through those in a second. The nice thing about this framework is, incidentally, you still get this same decomposition of optimal Sharpe ratio being market Sharpe ratio plus squared plus information ratio squared. It's just those terms are adjusted. But I want to make some critical observations here. The first point to make, and again, the best way to look at this is to look at the term for Y star, IR plus C SR prime over lambda nu. The first point to make is that it's the rate at which the Sharpe ratio improves that is the critical variable in this model, not the level of the Sharpe ratio itself. And that makes sense because if we're taking more active risk, we need to understand how quickly Sharpe ratio is improving given the additional risk we're taking. So we need to understand the gradient of the market Sharpe ratio. But crucially here, I'm going to say SR prime acts like a supercharger to IR. You notice it's on the numerator of this Y star, which is the exposure to active. So it's like extra IR. Why is it extra IR? Well, because we assume that SR prime could never be negative. So it's got to be bigger or equal to 0. And more importantly still, it's multiplied by this variable C, which is the supercharger. C is the ratio of market risk over residual risk, which is much bigger than 1. In our case, it's above 3. And what that says is that any improvement to the market Sharpe ratio by having the right proportion of people invested actively is 3 times as important as IR. 3 times as important. So all of the studies we see, and I'll declare a view here, I find it very tedious when I see yet another published piece of work on the average alpha of mutual funds and the like, and it's presented at conference and everyone sort of titters in the audience that it can't work as an industry. I find that very tedious, and the reason I find it tedious is this model would suggest it's far less important than what is the improvement to Sharpe ratio from having active managers. Far less important. Of course, we still need some improvements. If there's a negative alpha, we'll still need some improvement in the market Sharpe ratio to warrant an exposure to active. And for those of you that hate all this, or don't believe that Sharpe ratio is endogenous, if you plug it in, bottom bullet point, if you plug it in as an exogenous constant, you exactly recover the Treynor Black model. So what do we think this Sharpe ratio function is? I don't know, really. It's a piece of work still to be done. My instinct is the shape of it will be something like this, that once you've got a certain proportion of the market that's active, there's enough analysts that are making sure that the market, that the capital is allocated efficiently around a market. But I could imagine that there's a drop-off point, I call it P high, the cliff edge here at 20%, where you quickly drop from that if there aren't enough analysts to a much lower Sharpe ratio. That's the sort of shape I'm expecting. Where this cliff edge is, I don't know. Has to be lower than 50% because we're already at 50% passive and the market seems to still be operating okay. Is it much closer to naught? Could be. The reason I put in 20 is that when I was working at Fidelity, I went to see a mining company in Australia, and they were trying to raise capital by issuing these very unusual instruments, a bit like mining royalties. and they were incredibly attractive to the investor. And I spoke to the company and said, look, it's certainly as an investor, I find them attractive. I just don't understand why you're issuing something in such an expensive way, why you just don't tap the capital markets in the normal way. And this guy said, analysts don't come here anymore. And it's the first experience I've had of a company struggling to use the capital markets because the active community no longer visit companies in the Australia. I trod on something.
I think it's repaired.
Okay.
If someone on Zoom can confirm that they can still hear us.
I trod on a lead. Are you still hearing me?
I can hear you, but the audio is choppy. Did you guys hear me?
I think the thing would be sort of self-correcting though.
Yes, I haven't ruled that out actually, Lisa. I do think it can be self-correcting. And fun enough, it could even be self-correcting without the industry of active managers. It could be self-correcting with companies, with individuals trading. One of the questions I got when I presented this last week in Las Vegas, the audience had mistaken active managers, the phrase I've used, with active managers, the industry. And they're different things. The industry is a subset of all people who are active. So it's entirely possible that the active management community in the industry could die out, and there's still enough people self-correcting to ensure that that you stay above that cliff edge.
Yeah, or it reverts. History is full of us losing things that were valuable and then have to find them again. It's not been a linear path, I'm sure.
Yes,
I think it's fine now, but maybe someone on Zoom could confirm that they can still hear us.
Garrett did. He sent a chat saying he could
But it's-
okay.
hear, but that it was choppy.
Yeah. To hold that thought, Lisa, but I'll talk about that in the Q&A at the end because we'll come back to that. So here, I think it's going to look something like this. This Sharpe ratio function. So I'm just going to do some worked examples using this where we start at 0.3, but it drops to 0.1, somewhere between 10 and 20%. Now, what happens in that case? I'm going to do the three scenarios. The first scenario is alpha is greater than 0. And what you see plotted on the screen is that objective function f. Now, on the horizontal axis across the bottom is the portion of the market that's going to be active. And on the vertical, the left axis is the market exposure. This is less interesting to us. We want to know how far along we are this way. And you can see that if IR is positive, you can ignore everything I've said. You're bound to be invested in active managers if you believe they can outperform. So the optimal point is right to the right-hand side. You'll be 100% in that case. But if IR is 0, it's interesting that we now get a slight downward slope from left to right. And of course, we get that because we're not picking up any additional alpha, because it's 0, but we are having to face residual risk by having more active. So we would expect a downward slope to our objective function, but note the downward slope only occurs to the cliff edge, we call it P high, and the improvement to the market Sharpe ratio is high, sufficiently high, that the drop off here is, there's always a drop here. The positive optimal point always occurs at P high, and in the paper that accompanies this talk, you may be thinking, oh yes, but that's just the values of SR that you've plugged in, David. In the appendix of the paper, I show that any plausible value of this shape function results in the optimal point being at that peak P high. And perhaps more interestingly, even if IR is negative, so here I've put really quite an aggressive negative IR in. I've assumed that alpha is 0, but there's a cost of 1% to being informed. we have to pay a 1% fee to buy an active fund. Then we see a sharp reduction as we go from left to right. As we become more active, not only are we paying, we're experiencing active risk, we're losing return from doing so. But again, notice that the drop-off in Sharpe ratio is far more important to us than the negative alpha. Even a negative alpha of 1% is nothing like enough to offset the drop-off in Sharpe ratio that we would experience if there were no active managers. This chart here explains the Grossman-Stiglitz paradox. It says that if you thought that the market Sharpe ratio is impacted by the behavior of managers, investors, and their impact on managers, then you would still allocate to negative IR managers because your experience of the improvement to Sharpe ratio would offset it. So if you like, doing your bit to keeping the market efficient through the use of security analysis, that is a benefit to you which you're prepared to face a negative IR for. And to be optimal, you should still make an allocation to a negative IR manager in that case. The problem with that is, why would you collaborate? Why would anyone collaborate? We're going to now consider this third case, this Grossman-Stiglitz case, but we're now going to consider the situation where, as investors, we do not collaborate. So I'm just taking the scenario that alpha is minus E, alpha is the negative, the cost of becoming informed. And I'm making an assumption which I've made deliberately because I think this makes it more realistic. There are a large number of investors, and because there are a large number of investors, an individual investor can't really affect P in any meaningful way. In that case, the individual investor would view the Sharpe ratio as exogenous to them. And they would have this functional form of their own personal Sharpe ratio. Here, rho is an individual's Y over W, not the market's Y over W. So there's the individual investor's decision to how much active versus passive to have is given by this formula. And you can see that on the numerator, the first term is an exogenous thing as the investor sees it, and you subtract off some other exposure as a function of how much active you have. But what I mean by that is that there's no point in being active. So consider this plot here. The axis on the horizontal scale is the proportion of the investor's allocation to active, and the vertical scale is the market's, is the Sharpe ratio of the investor's portfolio. I've put the red dot in. This is what the market Sharpe ratio would be if everyone was collaborating. No, it's not. Notice it's not exactly 0.3. The reason it isn't because the collaborative investors have faced this negative alpha to get as high a Sharpe ratio as they can. So it's a bit below 0.3. But what should an investor do who's not collaborating, knowing that there's negative alpha, under the assumption that they believe the market is already acting efficiently? They shouldn't have any active. They can assume everyone else has done the work to make the price discovery work, and they themselves should be passive. But what if the market hasn't reached this threshold? Then everyone's going to experience a lower market Sharpe ratio, but still there's no point in you being the individual investor in allocating actively for two reasons. Firstly, you're too small to affect P. And secondly, why should you be the idiot that pays for the price discovery that everyone else is going to benefit from? So in every case, the uncollaborative investor should have zero active. And it leads to the classic prisoner's dilemma. Everyone would end up being passive. And in fact, when we look at that trending chart that I showed you from the Federal Reserve, maybe that's what's going on. So how do you solve this problem? There's three. Two are non-starters, the third is controversial. Firstly, we could ask active managers to reduce the cost of being active. I.e., reduce the cost of becoming informed. The problem with this is that becoming informed is, if you reduce the cost of becoming informed, the chances are you're less informed. And the whole point of price discovery is that you need to be informed to correct the prices. So reducing the cost, maybe you can reduce the profit margins of some of these asset management companies or something like that, but you can't realistically reduce the cost of active management too far. So instead, you could ask passive managers to increase their cost, so there's no differential between the two. But why would you do that? The passive industry is an industry like any other, it's competitive. You should be trying to reduce costs as much as possible as an industry. So I can't see a claim for either of those two scenarios occurring, in which case the third and controversial point of this presentation is we might consider a levy imposed by the regulator, paid by the passive managers, allocated to the active managers. And the idea of this levy is that it would effectively be it would boost the alpha of the active managers, and it would offset the cost of the price discovery.
Can I ask a question? There's been some discussion about closet indexers. So these are firms that say they're active, but in fact, you find their performance is very close to the index. And I'm not sure how widespread that really is, but nonetheless, telling who's passive and who's active in terms of the government imposing this levy seems to be difficult. I mean, why don't I just set up a shop and claim I'm active, but then actually be passive and pocket the payment?
Yeah. So two answers to that. Firstly, the UK regulator has actually put their own thought into something similar to this, which I was pointed to when I presented this a couple of presentations ago. And they used the phrase that they viewed active management, the cost of active management, as a tax. And they said it's a tax paid by some to the benefit of all for price discovery. That's the word they used. And so they were kicking around how to consider this problem. And they said you could be clear on your definition of active and passive by, for example, you have to exceed a track and error threshold, or residual risk threshold, and that threshold needs to be meaningfully high. So, for example, I don't know, in any 3-year period, you might have to have a track and error greater than 5% as an active manager to be considered active. And were that sort of metric to be used, it would actually help get rid of closet indexes. Which would be a good thing, because here closet indexes would be in the worst possible situation. They would be considered passive, and therefore they'd have to pay the levy, even though they might be actually spending a cost on becoming informed. So measures like that might be used to identify or dichotomize the active and the passive. But again, in the same way that Lisa posed a question about the market, there's a similar question to be asked about formally defining what is active and what is passive. They're definitely on a spectrum in reality.
And increasingly, because of the proliferation of indexes, used to be rare standards, there were a few, but there were not. Now there, because of the ETF industry.
Yes.
And the tremendous value in having a lot of different things called index.
Yeah.
It's gotten much more complex.
It is much more complex, and this is probably the weakest point of this paper is things like factor indices, because they're kind of alpha in a sense. So
totally. I don't think that's not confusing to me, but a more subtle question is the one I tried to bring up earlier. So think of two of our favorite US indexes, the Russell 3000 and the S&P 500. They're both cap weighted, they're both have all the big companies in the US in them.
Yeah.
But if you look at the S&P 500 as a portfolio relative to the Russell 3, you find tremendous large cap bias.
Yes.
90% of the active weight is held by the top decile, is in the top decile of active weights.
Yeah.
So here I haven't even introduced, I haven't deliberately introduced a factor tilt, which is people
No,
thinking different things, US market.
yeah,
And so, and then there's like committees, like S&P 500 is not the biggest 500 companies. There's a committee that reconstitutes it.
Yeah.
And it makes a decision to kick out Tesla and just to,
yeah,
because it doesn't like the CEO.
yes, yeah. Yeah, I mean, this is a very theoretical paper, so there are definitely weaknesses in getting from here to the actual practice of investment management. But in principle, what this paper is trying to get at is that there's two types of asset manager. There is the type that isn't making an effort to understand companies and a type that is. And this is really trying to target the insurance of there still exists a number of people who are trying to assess companies.
Yeah, that's right. Now, of course, there's the investor perspective. So at our little company at Imperio, it's not far from the only thing we do, but certainly something we do a lot of, tracking an index, harvesting losses for tax purposes, which you could say should be illegal and do. And yet, from an investor perspective, this generates a tremendous amount of alpha.
Yes,
For certain types of investors.
yes,
And has become quite popular in the past few years. So, I mean, and then I also I've been meaning to send you this paper by this legal scholar. Her name's Adriana Robertson.
Okay.
Called Passive in Name Only. She claims there's no such thing as passive management.
okay,
And goes through a bunch of reasons why she thinks that. I think it is a great element.
yeah.
To the debate.
I think, yes, the way I've defined passive, there is a clear definition of passive here, which is the company makes no effort to assess, the passive manager makes no effort to assess companies.
And even if it makes an effort to assess benchmarks, as opposed to saying, I'm going to track this one and not that one, is that?
That would be active, yeah.
But I think that's one of Adriana Robertson's.
Yeah, okay, that would probably be active.
I mean, this is beautiful because it kind of makes a path through a very complex discussion, but as you say, it doesn't pretend to stand on a mountain,
No,
down and see any elements. So
no, the difficulty here, funny enough, in so the FCA wrote this quite interesting paper, that they didn't provide any modeling like this model has done, but they said was, how do we consider the impact of passive on price discovery? What does it mean? How do we think about it? That was what the paper was about. And they put together suggestions. It's a thought piece. It's not really a directive as a regulator would normally give. It's a thought piece. And they put together suggestions for how you might dichotomize the industry or the investment universe into active and passive. And it was things like, well, tracking error was the primary one they used, but the other was you could assess how much effort is being made inside. You could do like a research visit and assess how much effort is being made to try and identify the efficient allocation of capital around an economy, be it benchmark choice or be it traditional fundamental analysts, but it could even be quant methods. You could even have a company that's just value investing without looking at the companies. That would be a version of alpha in their definition. So possibly something like that could be done. But this paper is just throwing out there this idea of a levy, which I just want to walk through. I just want to show you some sort of numbers for it. The beauty of this model is it tells you how big the levy needs to be. And here's the formula for it. The formula is more complex than it needs to be because if there's a variable phi, which is incredibly small, it's just p high, which is a small number, times mu over sigma, which is also a small number, and that whole thing is squared. So phi is virtually zero. So in fact, the levy really just equals where you think p high is, click it, times the cost of being active. So for example, if you had a 50 basis point fee to active on average, then the levy would need to be 11.8 basis points to the passive managers. And it would work as follows. I'll skip that one. The really nice thing about this is that it forms a stable equilibrium. And I mean that in the following sense. Let's suppose we're in an environment where we have too many active managers, or the allocation to active managers is too big. Then the levy collected from the passive managers is going to be small. It's going to be distributed amongst a wide number of active investors, and therefore the additional alpha they get won't be enough to offset the negative alpha. They will still be seen as negative, and the proportion of active managers will reduce. But when the active management community is very small, so now we're say at 10% active, then there's a big levy collected from a lot of passive managers, and it's distributed to just a few. And therefore, the individual boost that an active manager will get will be high. It will exceed that is required to generate a positive IR, and the exposure to active managers will increase. And it will therefore converge to a stable equilibrium at P high. It converges to that cliff edge. So one thing that's possible is that the regulator could speak to academia, could identify somehow where that cliff edge is, and set the levy at that point. Now, those who think levies are a bad idea, and I have to say, yeah, I can see the negatives of a levy. I'm more of a capital market person. You wouldn't have to implement this levy until you got to the point where you thought the cliff edge was. So what this levy would do, if there was a trend in active to passive, the levy would stop the trend at that point. So if we got down to 20% active from 50 we are now, i.e. the trend from active to passive continues, the regulators could wait till it gets to that point, identify at that point, actually this has now harmed the market or is on the verge of harming the market, then implement the levy. And all the levy would do, it would stabilize the trend to whatever point they pick, in this case 20%.
I'm imagining a whole new industry of closet active passive managers masquerading as active managers to avoid paying the fine.
Yeah.
Just as we have closet indexers,
Closet active.
closet active managers.
Yeah.
Secretly tracking, well, and also if I may say, active managers have a tendency to overstate.
Yes.
And what is the effect going to be on that sort of hubris?
Yes, that I'd share your view on that. The one, I think the game playing by managers is plausible, but the one thing that this structure has going for it in that sense is this does nothing to change the rankings of active managers. So it just simply gives the appearance of having a boosted IR. So they'll all move up and all down. So the bottom ones will still be bottom and presumably won't be allocated to. So if we had someone who was just gaming and with no skills, they would be bottom of the pile anyway. They still wouldn't be allocated to.
They could be very lucky.
They could be lucky, yeah. Yeah, that's the sort of the standard luck versus skill argument.
The numbers you showed before show that the certainty in the market vastly outweighs any signal, which is one of the reasons why it's so difficult in the first place.
Yes, yeah, that's true. That's true. But the weird thing about this, the thing that intrigued me about the model is we don't actually need active managers to be out, we investors, we don't need active managers to be outperforming, but we do need them to be trying to outperform. That's the peculiarity of this model. So this is really where I left when I presented it to academia. We need academic study here. We need to know what this Sharpe ratio function looks like. If it's flat, then we could just chuck this model in the bin and move on. But if there's some steepness to it, I showed previously that even the slightest steepness means it's more important than IR. So my message, I've presented this to a couple of business schools, is, you know, I don't want to see another study on average alpha of managers. It's not interesting. I'm much more interested in, do we know what the shape of that SR function is? How do we start looking into that? How big a drop might it be if there is one? Where does that drop occur? All important questions. And I would argue it ties into responsible investing. So there's this big trend, at least in Europe, toward being more responsible for your investing, socially responsible investing, ESG, and so on. I would argue that we as investors, we have a similar responsibility to the market that we're investing in. And the market itself, the allocation of capital. So I put this on. So I think the idea of being passive in this sense is hypocritical, especially being passive into responsible products, because by being passive, you're not being responsible for the market itself. So I think there's a hypocrisy there. So that's the model. The conclusions are fourfold. The main one is that if we believe that as investors we can affect market efficiency by our decision on active versus passive, to the extent that the Sharpe ratio is endogenous on us, then we need to reconsider portfolio construction. The second point is really to urge anyone interested in research to start looking at SRP. What does it look like? Shape is it? How big is the drop, if there is one, so on. And if there is any kind of increase, and the paper that accompanies this, the level of the increase required is absolutely minuscule to warrant an investment into active, even if the active is underperforming. The question then is, how can we persuade passive investors to act more responsibly, to accept that they have to be at least partially involved with price discovery? And the beauty of the levy here is that if an investor went from being 100% passive to, in our case, 20% active, 80% passive, they would experience no different in return. The levy, on the one hand, they're paying the levy, but on the other hand, they're receiving it through their active allocation. So they would experience no different a return at all. The only investors that would experience a difference in return is those that continued to be 100% passive in an environment where the levy was being charged. So my question really, you can imagine every time I presented this, there's been a lot of discomfort in the audience. The Q&A in some cases has been fairly challenging. But my position is, well, if we don't have a levy, what else should we do to ensure that we continue to have a decent amount of price discovery? Lisa, that was it.
So I have can we persuade? Well, one thing is looking to the values alignment. We could also think in terms of carrots, not sticks. So if you look down, you've got a stick here, which is fine. Yeah. But if you go down to younger generation investors, start talking to them about including their values in their investing, whether that's a good idea financially or not, you get a lot more interest.
Yes.
And for the same thing here, having more interesting and connecting talks, not such dry material, showing people how interesting these markets are, I think is a way to get people to participate in different ways. Yeah. And they would also, I think, realize, I don't know what your curve looks like. We've talked about it before, I'm wondering. But it's pretty clear from the extreme that if everybody's passive, there's no information. So you need at least some. Yeah. And again, somebody will say, hey, wait a minute, there's information out there, I can get ahead and possibly be motivated to do it just by the self-interest. At least some of that might be available. But it's certainly all great questions.
But I do like, I mean, if I had the choice myself, if I really thought it would work, I would prefer the carrot one that you suggested. I think that we could have conversations with investors and say you really need to make sure that you're doing something to help with price discovery, rather than, as you say, being a stick.
Well, helping people, if people think it's in their own interest, then they might do it. But one thing
Yeah.
we're doing that's totally against it is we evaluate managers or institutional investors, certainly in this country, evaluate managers relative to the benchmark.
Yes.
And that is working exactly against.
Yeah.
That, because it
Yeah.
doesn't matter whether all votes are rising, right?
Yeah.
It just matters whether my vote is lower than somebody else's. So
Yeah.
changing from a relative to an absolute perspective, and people have never been very good at that. Go
No.
over and say, a guy over there has better product.
Yeah, that's right. I do share your view. The one thing that I think that's coming back to the carrot rather than the stick, the one thing that I think is going in the favour of this idea is the trend in unbundling. You know, it's big in Europe now. There was a regulation, MiFID II, which said that companies were not allowed, an asset management company could not pay a commission to a broker for equity trading, and within that commission receive things other than trade execution, such as research, analyst reports, and so on. In Europe, it was very profound, actually. The regulators came out and said, you've got to separate those things. And if you want research from your broker, you pay for it separately. You can't pay through trade commissions anymore. And as a consequence, trade commissions came down, and the argument meant that it was less friction for trading. But it also meant that the asset managers then had to pay for this research. So it's completely changed the relationship between investment banks and investment research. Some of it for the better, some of it hasn't worked out quite as the regulators had hoped. But the idea of paying for elements separately does feed into this. Well, if you're using price discovery, you should pay for it. If you're not contributing to it via the being informed, you should somehow pay for it. That's kind of part of the principle of unbundling. So.
I have a question.
Oh, one sec, there was someone who put their hand up in the audience. I'll come to the Zoom call in 1 second.
Okay, thanks.
The point of like uncollaborative investors, where the proportion of active managers is very high, the prisoner's dilemma shows up where it's more likely for an investor to become a passive or allocate their funds towards passive managers.
Yes.
But because like becoming one more active manager doesn't affect the proportion in any way. But then wouldn't the total proportion start moving lower and lower until it becomes a significance again?
Total proportion of active
managers.
Yeah, the difficulty here is even if you've got a very small community of active managers, let's say you've only got 2, there's still going to be one winner, one loser. Because they're the only people trading, the average of what they do still has to be 0. But it is the case that if you only had a very small number, the opportunities to the individual manager are much bigger. So what will probably happen if we ever got to the point where there was only 2 left, the volatility of their return streams is probably going to be much larger. So someone's making big off an individual trade and the other person's got it wrong and lost big, but they still add to 0. For your logic to be the case, and it could very well be the case, there would need to be some fool who's persistently there. So some fool takes the other side of all these opportunities to the ever more increasingly obvious, to Lisa's point about self-correcting. There would still have to be some idiot who would say, oh, I'll still take the other side of that trade. So, the question is, who would that be? And I presented this a couple of times, and some people said, well, it's the passive, because they're buying without looking. But it isn't the passive, because they don't buy a single security, they only buy everything. So you couldn't possibly exploit the opportunity off of them. There's one on the Zoom call.
Yes, thank you. So a really interesting presentation. Question is about, it goes back to the price discovery assumptions. Many times, especially from information theory, it's not apparent. Like there are like companies make announcements or their drug discoveries or their technological innovations that don't that I'll just take the most recent one, like the AI discovery in the last few months, that it wasn't as apparent how far reaching it would be until more time down the line. And you do make that point in regards to the Microsoft one, but the price discovery process does play out, how we should say, it's an incomplete information in game theory terms, an incomplete information scenario.
Yeah.
And it's one, it is extremely dynamic. There's like we're seeing in this current scenario with the marketplaces that there are a lot of emergent properties are coming out, especially as we're seeing players who usually don't are not involved in this tech space suddenly become involved, or tech is involving itself in areas that it doesn't normally get involved.
Yeah.
So the question I have here is that when you have that type of structure, then I mean, I would say it's a little hard to extrapolate to or for a consistent SR function. But I assume that you've thought this out, so I'd love to hear your thinking on it.
Yeah. Yeah. So there's a couple of points to make on this. Firstly, one possibility is it does take time for new information to be understood. It's not instantaneous. And therefore there may be some tail. We saw it with the Microsoft picture. It took 3 months for Windows to become fully understood, the gravity of Windows. And in fact, there was a paper presented at CQA, I forget the author now, Russ Wormers presented it, saying that it looked to him like it took on average 3 months for information to be fully priced into securities. So it does take time. And therefore, it might be possible for active managers as a collective to generate alpha, exploiting the fact that it's not immediate. The problem with the empirical data suggests that they don't, for whatever reason, that the average alpha is still negative. So it's not clear to me how that plays out. The second question. Sorry, my memory's gone for a second.
I can help repeat if you like. Is that I mean, there are, especially now, I mean, especially in the last 10 years, information sharing has become much more dynamic. And I would argue that certain dynamics are becoming emergent that we are not seeing before, like new entrants in the market, like new players like Wall Street Bets, or players like that are now making significant, are actually market movers. So this, I was wondering what your thoughts are on how the SR could count for that. Since that, I mean, that's technically uncorrelated, but that's a big theta.
Yeah, absolutely. Yeah, I completely agree with you. Really, that's one of the motivations of doing this body of work. That when we move along the p-axis from p equals 0% to p equals 100%, I don't want to give the impression that it's more of the same. So, for example, if there are equity analysts looking at companies, and we just have 5 companies looking at 5 groups of equity analysts looking at companies rather than 4. I don't really mean that. What I mean by a higher P is you've got different types of analysis going on. And for the reason you've just stated, I think that's even more important now than it has been. Because there's a lot of, should we call it left field stuff going on, because there's a lot of new things going on, there needs to be a lot of people analysing these companies to make sure this is all picked up. So my personal view is that, and really one of the motivators for doing this work is we need a high P relative. If you said to me we've got 5% of the market that's active, I'd be very surprised if that's enough to pick up the price discovery through all the dynamism you just referred to in your question. And someone pushed back and said, yeah, but the companies themselves could be doing it. I'm not persuaded by that, because I had in my mind's eye the famous Kodak story where they just didn't see the digital photography coming. So I don't think an individual company necessarily is aware of the interesting innovation that's coming out in its blind spot, which you've just gave some examples of. I think there needs to be a lot of analysts doing that, and they should not be a homogenous set of analysts. The beauty of a higher P is you're picking up all sorts of different types of people doing all sorts of different type of work to try and understand the information content of companies.
Okay, well, I'll think about it. Thank you.
So I think we're up against time here, so let's thank our speaker again. And next week, we will have, I think it's virtual only, is that right?
Maybe it might be hybrid.
Next week, my old friend and former colleague and current competitor, Ben Davis, is going to be talking about loss harvesting. And it will definitely be on Zoom, and it may also be here in person, but please watch the announcement and we'll have the details.
It will be in person.
It will be in person. It's another hybrid talk. So show up in person if you can. If not, we're delighted to see you over the web. And between now and then, have a wonderful week.
Thanks, Lisa.
Thanks, Lisa. And Lisa, sorry, I can't make it to the lunch today, obviously.
Next time, Jeff.
All right.
You set up a meeting with budget start time I will be involved. I'll be different than get my note about this. Thank you for your help. There'll be more.